Late on Tuesday night, the House of Representatives approved legislation that would allow Congress to expedite bills that raise the federal debt limit and prevent unprecedented defaults. Democrats say the increased borrowing authority is needed largely to cover the cost of tax cuts and spending programs during former Republican President Donald Trump's administration, which congressional Republicans supported. If the Senate passes the House-approved bill, a second measure raising the debt limit under the expedited procedure would then be debated for a maximum of 10 hours in the Senate, instead of the open-ended debate that can delay or kill many bills in the chamber. Senate passage by a simple majority would clear the way for a final vote by the House. Both chambers are narrowly controlled by Democrats. By facilitating passage of a debt limit increase but not actually voting to implement one, Republicans would give themselves ammunition to attack Democrats in the 2022 congressional election campaigns for raising the $28.9 billion debt limit. The U.S. trade deficit in October narrowed sharply as exports hit an all-time high, potentially creating conditions for trade to spur economic growth this quarter for the first time in a year. The trade deficit is narrowing big time and pouring even more fuel into the economy's tank, which guarantees stronger growth as 2021 comes to an end, said Christopher Rupke. The trade gap plunged 17.6% to a six-month low of $67.1 billion. That was the biggest percentage drop since April 2015, reflecting an increase in the flow of goods and services following disruptions caused by the COVID-19 pandemic. Exports of industrial supplies and materials increased $6.4 billion, with shipments of crude oil advancing $1.2 billion. The Omicron variant of the coronavirus could, however, temporarily slow international travel following recent restrictions on travelers from southern African countries. A separate report from the Labor Department on Tuesday showed unit labor costs, the price of labor per single unit of output, surged more than initially thought in the third quarter. Labor costs accelerated at a 9.6% annualized rate last quarter, revised up from the 8.3% pace reported in November. Also, the unemployment rate is at a 21-month low of 4.2%. Unit labor costs in the United States rose more than originally estimated in the third quarter, suggesting that inflation could remain high for some time. Labor costs rose at a 5.9% pace in the April to June quarter. They increased at a 6.3% rate compared to a year ago, instead of the previously reported 4.8% rate. Economists polled by Reuters had forecast unit labor costs would rise at an unrevised 8.3% pace. The surge in labor costs came at the expense of worker productivity, which fell at the downwardly revised 5.2% rate last quarter. Productivity was previously reported to have tumbled at a 5.0% pace. It grew at a 2.4% pace in the April to June quarter. Compared to the third quarter of 2020, productivity fell at a 0.6% rate. It was previously reported to have declined at a 0.5% rate. Hours worked increased at a 7.4% rate last quarter, revised up from the previously estimated 7.0 pace. The European Central Bank said on Tuesday it had picked Spain's Oscar Arias as the Director General of its Economics Department, a key position that involves preparing the ECB's growth and inflation forecasts. He took up that role in 2018, when his predecessor Pablo Hernández Decazes was promoted to governor of the Spanish Central Bank. Arias has a doctorate from the London School of Economics. His latest research focused on the effects of central banks' bond-buying programs. The French economy is set to grow a bit less than 0.75% in the final quarter of this year as firms grapple with an increasingly uncertain health situation, the central bank said on Tuesday. With France now in its fifth wave of COVID-19 outbreaks, the outlook was marginally less optimistic than last month when the Bank of France forecast 0.75% growth from the third quarter. Drawing on the findings of its monthly survey of 8,500 firms, the central bank said companies expected improved business conditions in the industrial and services sectors, while activity was seen stable in construction. Meanwhile, supply chain problems also got worse in the industrial sector, rising to 57% from 56% in October, with the car industry worst hit. However, supply problems in construction eased to 56% from 58%. The central bank estimated the economy was operating at 0.75% above pre-crisis levels of activity this month. Asian stocks extended their gains on Wednesday, continuing a rally of global relief as markets found positive news in early reports about the potential impact of Omicron options, but overnight gains in oil prices have begun to subside. Asia-Pacific shares outside Japan rose 0.3% and Japan's Nikkei rose 1%. US S&P 500 futures rose 0.25%. On Wednesday, the greenback was little changed against a basket of 6 major peers, although the Australian dollar extended its overnight gains to $0.7122, its highest in a week, having fallen to a 13-month low due to worries about Omicron and a comparatively dovish central bank FRX. U.S. crude dipped 0.45% to $71.79 a barrel. Brent crude fell 0.44% to $75.11 per barrel. Spot gold rose 0.3% to $1,789 an ounce, within its recent range, and rivaled inflation hedge. Bitcoin was also calm after an exciting weekend, barely changed at $50,600. Japan's economy shrank 3.6% in the third quarter, worse than the initial estimate of a 3.0% contraction, revised government data showed on Wednesday, posting a decline as private spending took a hit from a resurgence in COVID-19. On a quarter-on-quarter basis, GDP fell 0.9%, slightly worse than the initial reading and median forecast for a 0.8% drop.